How's it going, everyone? I just wanted to make another video because I know here recently when I released the standard deviation indicator, a lot of you has been asking about what settings to use, how do you use it, et cetera, et cetera. So today I'm going to be going over that and all the different ways that you can use it. So starting off first, this is originally meant to be a mean reversion indicator, which mean reversion, I mean, it can essentially be deviating from any time essentially, but the original indicator it was based off of sets it from 6 to 9, and then the idea behind it is you want to see it to go to 1.66, 1.33, or the negative deviation of that, and then essentially reject and then go back to the equilibrium because apparently there's data out there that says, going to those levels 80 something percent of the time it goes back to the 50% level. So generally you would just take the trade when it's down here as long as you're getting confidence that it's rejecting that level, and then you would ride it back up to the equilibrium. But I ended up getting a little creative with it and added in other things, which, as you guys have probably seen if you're already using the indicator, one thing I added in was the use higher time frame instead of session. So session could be used multiple ways. Like you can use this as a mean reversion, so 6 to 9 or whatever time period you want, or you can use it as like an opening range breakout indicator. So like if you do 9:30 to 9:45, essentially you can do those settings and whatnot. I personally prefer using the higher time frame, just because this is showing you 4 hours of price action essentially, starting at each new 4 hour candle. So it'll show you the previous highs and lows and deviations of that 4 hour candle. Um, so essentially, when you select body, it's not using like the physical body of the 4 hour candle. I had it set up like that originally, but the issue with it is whenever candles are like dojis or really small hammers or whatever, like just having small bodies in general, the lines that the deviations would just become sandwiched essentially. So I reverted it back to how I had it originally, which is uses the body lows and highs of that range of the start of that higher time frame candle. And then if you choose wicks, it uses the true high and low of that 4 hour candle. But so if you ever go to multiple time frames, you may see like going to the 5 or the 1 or the 15, the highs and lows when you have it set to body will change a little bit. But at the end of the day, it's all the same price action. You may have like a 20-point deviation. So don't let it trip you up as far as what type of trades you should be entering. But I guess mainly a lot of you that already use the indicator that are still curious about, how you really use it are here for one specific reason, and that's basically specifically how I use it. So like I was saying, I set it to the 4 hour higher time frame and body. And essentially what I'm looking for is a sweep of the highs or lows or any of these deviations in between here. Um, so like basically pretend a new 4 hour candle opened. So in this case, the 4 hour candle opened at this dotted vertical line, and price came down and swept the 4 hour low and inversed back up. This is essentially what I'm looking for because these highs and lows is essentially like sweeping, the high and low of a liquidity level. Like this is where price was traded at the most on these highs and lows. And the well, obviously equilibrium would be where it's traded at the most, but the highs and lows is essentially what you're looking for. You're looking for that high and low sweep, just like you would look for, a high and low sweep of equal highs, equal lows, et cetera, et cetera. And essentially you're just looking for a reaction to the deviations as well. So like if you come down here, you sweep the 4 hour low, but you also react to this 50% level, or this negative 5.5 deviation from the low, as long as you get a strong reaction on that level, then you can enter this trade, set your stop, either below these equal lows, you can set it right below 0.66 to give your trade a little bit of room to run, whatever the case may be, whatever confluence you have. And then you would enter from there. So a lot of times one thing I'll have is higher time frame for value gap. So in this case, we didn't have one there, but say we had a higher time frame fair value gap here, which I don't know if we. Oh well, let's try this indicator. No, no, not one there either. But I was gonna say maybe we have like a 15-minute or a 5 minute that we could have rejected in that level, um, which we did technically. That one was a 5 minute inverse fair value gap, or I mean, a 5 minute fair value gap. I don't personally use the 5 minutes, but it's just extra confluence. So those of you that trade ICT concepts, smart money concepts, stuff like that, essentially the fair value gaps are going to give you, extra confluence whenever you reject these deviations. So whenever you're essentially overextended, this would be overextended, and you have a fair value gap here and a react to it, then it's just like extra confirmation that hey, we swept 4 hour low, reject this higher time frame fair value gap, I'm gonna get in the trade. So it's kind of like a confidence booster, if that makes sense. So like another example here, so we came back up to this high of the 4 hour session that we had, or the 4 hour candle that we had. You can see we obviously sellers stepped in, bearish hammer to the downside, take the trade. That's essentially the idea behind it. And then you can use these levels to determine where you want to target TP. So like, okay, we went to the low, we already swept low. So maybe we should only try target the equilibrium or the 25% level and see if we respect that level, and continue to push back up. And um, I would continue it, but if I continue, it's going to show you more deviations to 2 o'clock, which I'll do in a second. But that just kind of gives you the idea of like what exactly you're looking for. So like I was saying, example, you came up, slept 4 hour high and inversed, that's extra confluence. You're sweeping strong highs because that's a 4 hour period of price action that you essentially just swept. Um, Another way you can use it is if price were to open up, which let's see if I can find an example. If here's an example. So if price were to open up, so it opens here and then it immediately is already at the high, then at this point you can look for a potential short to the downside, because this is essentially, like I was saying, sweeping. Sometimes you may crawl all the way up to the 1.33, 1.66 area, and at that point you're overextended. So you're really just looking for a reaction to one of these levels at this point if it opens up like this. So another example is if you wanted to test how bullish a bearish move is. If you've watched my previous videos, how I like to use fibs is I like drawing them up from essentially the high to the low, and seeing how bullish or bearish the move is. So in this example, oops, I gotta change that fib. Give me 1 second. I'll draw it up anyways. So if I go back to my normal fibs, like this. So the way I usually use it, like I said, if you watch my previous video, is I try to see, how bullish or bearish the move was on the way down, like, or the move that comes back up. So like if I wanted to short this, but let's say it was way too far away for my entry and my risk was going to be too high. So I wanted to see if we retraced into a fib. Ideally I would want to see price come up into the fib, reject one of these levels, either 50 or 61.8 or potentially 786, and then show momentum back to the downside. But in this case, we busted straight through that level. So going back to what I was saying, we broke out of the high, swept this high, came back, retested 50% or the EQ. So 50% is the equilibrium. So at that point, if you see a strong reaction for an inversion, you know that this is a bullish pullback. So that's the idea behind it, And a lot of you people, or a lot of the guys that you may not trade ICD concepts, but let's say you trade bull flags and bear flags, which that's what I came from. So you got a bull flag here, you retest the equilibrium, broke out of the bull flag, that gives you extra confluence because you're using 4 hours, like I said, a 4 hour time frame of price action. And that's helping you determine how bullish or bearish the move is. So you bear flag, reject the equilibrium, and enter on the break of the bear flag. Or I mean, sorry, the bull flag. I don't know why I was calling it a bear flag. But yes, I mean, that kind of gives you an idea of like different ways you can use it. So, I mean, another example, we came back up, swept these highs here, and then inverse back to the downside, you could have wrote it back down to the high, see if we retested that high. And we did. We retested the high, chopped around on a little bit and pushed off. Came back up a little bit higher, made another high. So at this point, we're kind of creating a trend line. So at that point, you can trade bounces of the trend line. There's different, it's a very versatile indicator. So if you trade trend lines, if you trade ICT, if you trade bull flags, bear flags, wedges, patterns, et cetera, these deviations, at least the way I use it with the 4 hour deviations, is giving you confluence on, how bullish or bearish a move is. So you come back up, you reject your trend line, take an inversion to the downside. Okay, let's just see if we retest the high. We retested the high, and guess what we did? Bounced right back off of it. And the thing I like to look at is where, like I was saying, where bodies close is generally where price was traded the most. So, in this example, which I just drew that line on a terrible spot. Here, let me plot it like this, and I'm going to change the color and give you an idea. So like the body closed here. Let's see. Okay. So the body closed here. We came back, rejected this level, and closed higher. These are things that I pay attention to in the market. A lot of people can focus on wicks, but I prefer focusing on bodies a lot of the time because bodies, like I said, that's where price traded back down to or up to. In this case, we traded down to this level, respected it, kept on making higher highs and higher lows, and then came back down, but still made a higher low. So, most people are like, oh, well, we almost made a higher or a lower low with the wick. Well, where do the bodies close? These are things you got to pay attention to, or at least that I like to pay attention to, because at the end of the day, this is what price is respecting. I mean, if you were to just draw a line from here to here, which I know that's probably hard to see, but if you draw a line from there to there, at this point, you see that this bullish candle respected that level. It kind of swept that low of the body, closed back or opened back above or closed back above, however you want to say it. At this point, we can target deviations, whatever the case may be. Each of these levels can be TPs, whether you're a scalper, swing trader, whatever the case may be. If you're swinging, I know I'm going probably a little bit fast, but let's say you're swinging. Let's say you would wanted to retrace down to maybe the 25% level. If we respect this level, it's still a relatively bullish pullback as long as we inverse out of it relatively quickly. So at that point, you can target the high again and see how we respect that level. Or like I said, 133, 166 or 033, 066 or the 50% level outside of the high. Um, but yeah, I mean, that's kind of there's a bunch of different ways you can trade this. It's essentially like I was saying, it's just using the fib and seeing how bullish or bearish the move is. So when you see 75%, okay, we're retracing to the 75%. We made it down to the 50% level of this previous 4-hour candle. Okay, if we inverse back up with momentum, okay, we might actually go somewhere. In this case, we did. We went back right back up to where we were, swept the high like I was showing you, and just continued on from there. But it's a relatively simple indicator. There's not a whole lot to overthink about it. The way you have to view it, like I was saying, is just, how bullish or bearish is the move, depending on where it opens. If it opens on the high or it opens on the low, at that point, you want to look for a rejection and then ride it back to, like I said, 25%, the equilibrium. If you look at the higher time frames and say we have a bunch of engulfing candles going down, and then the next 4-hour candle opens going down through the low, at that point, it's a possibility we could have a pullback off of one of these levels. So at that point, if we're in a bearish trend, and let's say you counter trend trade, which if you trade iFVGs, majority of the time you're probably counter trend trading. Um, we come down, reject this level. Let's say we rejected 50% of the low deviation. At that point, trade an inversion back up to the 25% at the bare minimum, or at least the low, because you're going to react to the low, and then see if we can break through. And from there, you kind of use each of these lines as trailing stops or however you want to do it. But that's essentially the idea behind it. It's a relatively simple indicator to use. Just don't overthink it. Like I said, my favorite thing is the deviation side of it. So using the higher time frame aspect at least, because another thing, if you trade power of three, you know, you're trying to position yourself at the start of a 4-hour candle, correct? Okay, well, the 4-hour candle starts at 10 a.m. for New York session, like a new 4-hour candle. So we opened up here, and at this point, you can take a trade based off rejecting this level as long as you show the momentum down. But that's the idea behind it. And this is the start of a new 4-hour candle right here. But yeah, I mean that's pretty much all there is to it. There's not a whole lot to kind of go over with it. Like I said, you just kind of have to trade it. Like I said, if you haven't watched my past videos, I would recommend going to watch my past videos. I explain how I use fibs, and like I said, the idea behind it is, how bullish or bearish is the move. So, if I drew this fib from this high to this low, because at the end of the day, this high created this low, and then we had a pullback. Well, guess what? We retested, respected the level, and went back down. Would I have made profit on here? Probably not. But I mean, that's the idea behind how I use my fibs. Being in those deviations is going to give me a better idea because I mean, as you saw, being in these deviations, even though we respected 61.8, guess where we are? We're right here at the high. Rejected it. So I may want to see another retest of the high before I would enter in a short. But that's the idea behind it. These levels are going to be able to prevent you from getting faked out, especially on opening range breakouts. So like, let's say you trade 930 to 945, uncheck the higher time frame toggle. And then from there, we'll see where the deviations were. So we came up, retested 50%, came back down to equilibrium, and guess where we bounced? We kept bouncing on it. just bouncing on it multiple times. But that kind of gives you an idea, a lot of opening range indicators like, oh, we're breaking out. Okay. Well, where are we going? You know? So these deviations are going to give you visual examples of the reactions we could have to price essentially whenever we go up to specific levels, because typically deviations are also going to be where liquidity was. So in this case, 50% was right here where we chopped around before we dropped. This was news driven, but at the end of the day, you could expect people to have orders still placed here. But anyways, I'm not going to ramble too much more about the standard deviation indicator. I feel like it's pretty straightforward, but I will kind of glimpse over the settings a little bit. So down here, you do have alerts for all these levels. So, if you wanted to enable any of these, all you essentially do is check the ones that you want alerts on, and it's going to show you the plus or minus deviation for each of these. So if you select, let's say 0.66, it's going to tell you if it's crossing the negative deviation of that or the positive deviation of it. Um, Trigger down here is going to essentially be the name. So it's going to come up as crossing EQ or crossing low or crossing high, whatever, whichever one you select. Once you have these selected, all you're going to do, and another thing I would say, make sure you have those lines that you want um, uh, alerts on. Make sure you have them enabled. I haven't honestly tested out whether or not if these are enabled, if the alerts still work. Or if yeah, I wouldn't think they would if you don't have these enabled, but that is something I didn't test out. So if you have any issues in not enabling these, and let's say you enable alerts, but it alerts you, let me know. But anyways, like I said, once you have the ones that you want checked, and you keep this here where it says trigger, essentially you just go to the three dots beside the indicator. Okay, well, it's not showing me. Well, we'll go over to the alert icon. We'll add alert. Oh, that's why I'm in alert replay mode. Okay. Go back over to the indicator, and then you'll click add alert after clicking the three dots, and then essentially you just pick the time frame you want it on, which shouldn't really make too much of a difference. Like I said, if you're using the higher time frame toggle, the 5 minute chart may have different size bodies or different placed bodies than the 1 minute chart, so you may have a different alert there, but I would just do same as chart. There's no reason to really set it at a different one. But yeah, you would just create the alert, and then from there, you'll get alerted whenever these levels get crossed, essentially. Um, Alternatively, you can also go over to this alarm bell and then just click the plus button and then add it the same way. And then just make sure it's open ended so that way it doesn't cancel out or anything like that. But that is the idea behind it. But yeah, that's pretty much all I got for the standard deviation indicator. While y'all are here, I guess I'll go over and show you some of the new updates I made to the Pro Toolkit. Those of you that are using the iFVG Pro Toolkit. Um, so I added in all of these options. So I restructured everything, or more or less just reorganized everything. Made all the settings appear basically all in one section and kept the style stuff separate. Um, I'm still working on some things. I'm having issues with the Bollinger Band filter. So I don't know if I'll release that immediately. I may just send the update out with the updated version with the macros, and then some of the new features. And then the other thing I will send out beforehand is the TP level, which y'all kind of got a glimpse of, but I'll show you what exactly, or essentially what it is. So essentially it's a fib or a standard deviation fib, whatever you want to call it. And all you have is, let's see, 0.5 and the 2. Delete this real quick. But essentially, whenever these iFVG's entries plot, it's going to plot these lines on your chart as TP levels, which I got to redraw that real quick. But yeah, so it'll be something like this. So you'll have the TP levels they'll plot on your chart essentially, and it'll look like this right here. So you won't see the 0 or the 1. The only thing you'll see is the negative 0.5 and the negative 2, which I may remove these and just leave the 2. But essentially what you're doing is you're going to be trading deviations from the iFVG entry. So negative 0.5 could be like your first TP, or it could be your break even. Um, and 2 would be like your initial whole target. Which in this case, it could have either been a potential break even trade or whatever. Another thing I was actually playing around with was a stop loss as well, which would look something like this. So essentially, it can kind of give you an idea of where you would want to place your stop loss. Like I said, the only thing that'll show is potentially this line if I decide to add it in. I think default, I'll probably leave it off, but if you want to enable it, you can have it there in case you don't know where to place your stops. But usually, from I went back and tested like, I don't know, 100 different iFVG entries and placed these fibs on each one of the candles manually just to see what deviation I thought was best. And 1.5 seemed to be the best. So um, I'll have options in there where you can change the deviations of, the TP levels. And then you'll probably have the option to, if I decide to add it in, a couple more deviation levels because there are instances where the TP will be low, but the trade itself will run, 100, 200 points, whatever the case may be. Um, let's see if I can find an example chart. So this trade's example right here. So like I was saying, essentially the deviations would be plotted from here to here, and it'll look pretty much exactly like this, like I said, except for the 0 and 1. So you only see the TPs, the break even, and then the stop loss. So your stop loss is safe here, and TP2 hit or TP1 hit. Break even here, which your break even would be around this area. You never got hit. You know, different scenarios. See if I'm gonna find another one. But while we're looking for this, I guess I'll kind of go over this some of the updates for the indicator. Um, like I said, added in all the different style settings down here. So active is going to be like your entries that are either validated or currently plotted. And there's going to be essentially modes. So you have sweep, and then you have close. Close is essentially whenever price closes through the fair value gap that was inversed. By default, it's quote unquote invalidated. Sweep essentially allows price to close through it. But currently, the way I have it set up is it has to sweep the opposing liquidity, but I'm pretty sure I'm going to set it up to where it's based off of the stop loss positions or the stop loss, like standard deviation fibs that I have set up. I'm not really sure yet, but essentially, like whenever sweep is enabled, like for this example, price would essentially have to come back up here and sweep buy side liquidity, and then it would be invalidated. The way Dodgy's indicator works is essentially this would keep extending until invalidated, but I have it currently to where it just stops, just because there are instances where it just extends forever. And the issue with that, and the only reason I did it this way is because we're getting near all-time highs, and there's going to be instances where trades will essentially just continue to extend, which I added conditions in there. So like if the same exact entry appears, at a different spot, it'll stop it from extending. But, for active entries and stuff like that, in case that occurs. But, the issue with the dynamic one, so essentially the delayed one, is this could essentially keep extending forever, if buy side liquidity never gets swept from going through all-time highs. Um, but yeah, so for now, those are just going to be static. They'll stop extending as soon as it's delayed, quote unquote, and then you would just kind of watch the entry from there. So I mean, whether you want to draw a line yourself, or if I end up adding an option where it can continue to extend, then I will. But essentially, this would eventually be a validated iFVG. But and this is kind of where the fibs come into play. So like I was saying, I had it to where the fibs are default, which is probably not a good example, but it's based off the candle high and low. So ideally, like you would want your stop loss up here. So if the candle were a little bit bigger, your stop loss would have been safe up here. And like I said, that's kind of discretionary on where you want to put your stop loss and stuff. But that's the idea behind it. It just kind of helps with stop placements. In case you struggle with that. But yeah, been taking my time on everything. Trying not to rush. I've kind of had to backtrack with the indicator itself because there's a lot of things and a lot of features that I added in kind of prematurely before I got everything working exactly how it should. And if you guys don't know, I'm big on using AI, so like I can code, but it's mainly just restructuring things. So organizing and the formatting aspects. So I'm good with that. But when it comes to like writing from scratch, I kind of suck at it. So that's something that I'm gonna have to learn down the road, which is why it's also been taking a little bit of time because sometimes I'm limited by AI. So I have to reach out to other people for help, et cetera, et cetera. But it kind of gives you an idea of things to look forward to. So essentially, the way I'm going to have it set up is this line will extend until break even is hit. So you won't have a bunch of long lines on your chart, or or I might make it until it extends until TP2 is hit. But I'll probably just do break even because this one's going to get more often than not. So if break even's hit, then it'll stop extending. Or if it hits 1.5, then it'll either go delayed if you have sleep mode enabled, or it'll invalidate if you have close enabled. So that way they'll stop extending as soon as you hit one of these levels, and you're able to automate it and whatnot because I'll add alerts in for those levels. So essentially you'll type in the JSON message that you want in this box, and then you can click the alerts that you want to automate. So like plus iFVG, minus iFVG, stop loss hit, break even, or TP1, whatever. I haven't figured out how I'm going to set it up exactly yet, but it'll be something similar to what I was kind of explaining. So then, whenever the order gets placed, it places your order. Once it says break even, then you go break even. When it goes to TP1, then it closes the trade in full. However you set it up, I'm pretty sure there's like ways to customize it, but I'm not too savvy with the whole JSON automating and whatnot. But yeah, that is pretty much all I have for you guys today. Like I said, I'm not really sure when I'm going to send this update out yet, but it should be sometime in the near future. I would say hopefully I'd like to get it sent out by the weekend, ideally, but no promises. It may be next weekend or something like that. But yeah, if you guys have any features you want to see me add, feel free to comment and I'll try and read them whenever I can, and we'll kind of go from there and figure out what the what features would make sense and what features wouldn't, et cetera, et cetera. But I appreciate you guys. If you haven't used this indicators yet, I will have a link down in the description, which will be for the toolkit as well as the standard deviation indicator. And there'll be links to our discords, my personal Discord, community Discord, as well as a buy me a coffee, in case you appreciate what I'm doing. You've been using the indicator and you want to show some love, feel free. But other than that, that's all I got for you guys. I hope you guys have a great day. And I'll catch you in the next one.